January 21st, 2026, global markets lost $1.2 trillion in a single, chaotic day, all because the president threatened Europe with tariffs over Greenland. 48 hours later, everything reversed. But what did he really want from Greenland? And why were investors caught so completely off guard? The answer changes everything about power, money, and the new Arctic battleground. January 17th, 2026. The White House podium stands at attention as President Trump delivers a pointed ultimatum. 8 European countries, Denmark, the UK, France, Germany, the Netherlands, Sweden, Norway, and Finland, must accept a U.S. acquisition of Greenland or face sweeping tariffs. The threat is precise: a 10% levy on all imports, with an escalation to 25% by June if there is no deal. The statement lands just before markets open, sending brokers scrambling for updates. Traders on Wall Street and in London swap frantic messages as the news flashes across terminals. Some call it a bluff. Others remember last year's tariff reversals. But no one is willing to risk it. By noon, the phrase taco trade starts trending in financial chat rooms, shorthand for betting on another presidential reversal. Yet as the day wears on, the threat hangs in the air. No one knows if this time the president will follow through. On January 20th, the phrase "Sell America" lights up trading floors. Screens flicker red as investors dump shares at a pace not seen in years. By midday, the S&P 500 is down more than 2%, with European markets trailing close behind. Traders, glued to their terminals, swap rumors about a possible circuit breaker. The losses stack up fast, and analysts estimate over $1 trillion in equity vanishes in less than 6 hours. Social feeds fill with a new shorthand, taco trade, a bet that Trump will reverse course before the pain gets worse. On January 21st, the sell-off deepens. Headlines blare the damage, and major funds scramble to hedge. Then just after the opening bell on January 22nd, a single statement hits the wires. Trump announces a framework deal and cancels the tariffs. In minutes, stocks surge. The rebound is sharp, but not complete, and the scars of the drop are still visible in the tick charts. The question hangs, why back down now? Greenland sits atop a treasure trove of rare earth minerals, metals essential for everything from smartphones to fighter jets. Geologists estimate the island's reserves could be worth trillions, enough to challenge China's grip on the global supply chain. For years, Beijing has controlled up to 90% of the world's rare earth exports, making Western economies vulnerable to sudden shortages or price spikes. Greenland's untouched deposits offer a chance to break that monopoly. As Arctic ice retreats, new shipping lanes are opening, promising faster routes between Asia, Europe, and North America. Defense analysts warn that whoever controls these passages will shape the future of global trade. The U.S. military already operates Pituffik Space Base on Greenland's northwest coast, a launch pad for satellites and early warning systems. Full control would give Washington a strategic edge in the emerging Arctic contest with Russia and China. For the White House, these assets justified extraordinary pressure, even if the cost was global market turmoil. Tariff threats rarely stay on paper. When the White House floated a 10% duty on goods from 8 European countries, traders knew the cost would not stop at the border. For American businesses, the math was simple. Every extra percentage point on imports meant higher prices for the next buyer in line. By the time tariffs reach the checkout lane, even a modest hike can snowball into real pain. Budget models projected that if the full 25% rate took effect by June, the average U.S. household would pay $2,100 more per year for everyday goods, everything from cars to kitchen cabinets. Some sectors faced even steeper jumps. Industrial imports like steel, autos, and semiconductors were set for a 25% hit, while certain categories, pharmaceuticals and cabinetry, hovered at the threat of 50 or even 100% duties. Households would feel that squeeze. That is not just sticker shock. It is a direct squeeze on family budgets. Meanwhile, legal teams raced to file challenges. The so-called Cook case, now docketed at the Supreme Court, questions whether the president even has the authority to impose such sweeping tariffs without Congress. Until the justices rule, every business and consumer sits in limbo, watching prices and risks climb. Stock portfolios shrank overnight as the sell-off erased months of gains. Mortgage rates jumped, catching home buyers by surprise, and lenders posted new terms with higher monthly payments before lunch. In grocery aisles, price tags for staples like bread and eggs crept up by double digits, squeezing family budgets without warning. Small business owners scrambled to recalculate payroll, facing higher costs for imported parts and dwindling cash flow. One furniture retailer in Ohio watched his cabinet costs double in a week, forcing him to freeze hiring and delay raises. Across the country, workers checked their pay stubs and found little to celebrate. The pain of tariffs registered not as headlines, but as real choices at the checkout line and on the shop floor. European officials wasted no time crafting a response. By the end of January, the European Union trade chief threatened countermeasures totaling $100 billion, aimed squarely at United States exports from agriculture to technology. Policy strategists recognized a familiar playbook: threaten, trigger panic, negotiate, then claim victory. It is the same formula that drove earlier tariff battles with China and the United Kingdom, now scaled up to the largest trade tax threat since 1993. This time, Europe's warning signaled the risk of a full-scale trade war if the United States kept pushing the limits. Today, global markets react to leaders' threats in real time, no matter the target. The next shock may not be a bluff. For investors and voters alike, the uncertainty is the new constant.